COMEX. The exchange that sets the price of silver for the entire world is running out of metal, and the math says it hits zero by March 6th. I'm not being dramatic. I'm reading you the data straight from COMEX warehouse reports. 5 months ago, there were 200 million ounces of deliverable silver sitting in the COMEX vaults. As of February 19th, that number is 88.79 million. 111 million ounces gone, drained out of the system at a rate of 20 million ounces per month. And the drain is not slowing down, it's accelerating. At the same time, the March to May contract roll is failing. In simple terms, futures contracts have expiration dates. When a contract approaches expiry, most traders roll it forward into the next month. They don't want the metal, they're just trading paper. But right now, the contracts in March are not rolling into May fast enough. The exchange needs to move roughly 30 million ounces worth of contracts per day. Yesterday, they moved 15, half the required pace, which means when first notice day arrives on February 27th, 5 trading days from now, there could be a massive amount of contracts still standing in March, demanding real silver from a vault that's been losing 20 million ounces every single month. And here's the part that took my breath away. While I was going through this data today, a major silver miner released their earnings, and their numbers confirm something that I think changes this entire story. The real price of silver is not what your screen says, it's much higher. And now 2 completely different mining companies from 2 different countries have proved it with audited numbers filed with regulators. By the end of this video, you're going to understand exactly how COMEX got here, why the vault trajectory points to zero, what the failing roll means for February 27th, how 2 silver miners are both getting $69 when the market says 55s, why the US government just said pricing is the key and 5 specific signals to watch over the next 5 days. Let me start with the vault chart, because once you see this, everything else makes sense. I'm looking at the COMEX Depository Warehouse registered silver stocks chart. Registered means deliverable. This is the silver that can actually be handed over when someone demands delivery on a futures contract. And it's collapsing. In September 2025, registered silver was 200 million ounces. October, it started falling. November, faster. December, steeper. January, much steeper. And in February, it's falling off a cliff. The current number is 88.79 million ounces. That is a decline of 111 million ounces in 5.5 months. An average of 20 million ounces per month leaving the registered category. Let me put 20 million ounces per month in perspective for you. Global silver mine production is roughly 820 million ounces per year. That works out to about 68 million ounces per month. So COMEX is losing the equivalent of about 30% of the world's monthly mine production from its deliverable stockpile every single month for 5.5 months straight. And if you look at the chart closely, the decline is not linear. It's curving downward, getting steeper. From August through November, the drop was gradual. Then December and January accelerated, and the February numbers are the worst yet. This is not a steady drain. This is an accelerating drain. Now some people will say there's eligible silver in the vaults too. Eligible means the silver is in the vault but not currently available for delivery. The owner hasn't made it available. And yes, theoretically, that silver could be transferred into the registered category. But here's what the data shows. The registered decline of 20 million ounces per month is the net number. It already includes any transfers from eligible into registered. After all the inflows, after all the transfers, the system is still losing 20 million ounces per month. The eligible transfers are not enough. The system is net negative and it's getting worse. And there's something else happening that almost nobody is covering. As the gap between the Shanghai physical silver price and the COMEX paper price widened to 18 per ounce when silver ran past 120, silver started physically leaving New York and shipping to China to capture the premium. So COMEX isn't just losing silver at deliveries. It's losing silver to international arbitrage. Metal is flowing east because the price is higher there. And once it leaves, it doesn't come back. Now, let me show you the delivery data that makes this even worse. In February 2026, the delivery rate on COMEX Silver was 98%. Let me explain what that means. In a normal futures market, when contracts approach expiration, most people roll forward or close for cash. Typically 5 to 20% actually stand for delivery and take the metal. In February, 98% stood for delivery. Virtually everyone wanted their silver. That is not a futures market. That is a physical allocation system. January was even more alarming in a different way. January is normally a quiet month, minor delivery month. In January 2026, COMEX delivered 49.4 million ounces of silver. That's 4 times the January 2025 level, 7 times January 2024. A minor month turned into a major delivery event. Why? Because traders are front to running March. They don't trust that the silver will be available in March. So they're grabbing it early in January and February while they still can. And zoom out even further. Total COMEX silver deliveries in 2025 were 474 million ounces. In 2024, it was 202 million, more than double. Every single month of 2025 had higher deliveries than the same month in 2024, 12 months in a row. This is a systematic shift from paper trading to physical metal demands, and the vaults were never built to handle this volume. Welcome to the hidden economy. If you're new here, subscribe and hit that like button. It really helps the algorithm and keeps me motivated. Thank you. And now let me show you what's happening with the March roll, because this is where the March 6th number comes from. I'm looking at the COMEX Silver Futures open interest data from February 19th. March 2026 open interest is 53,152 contracts. Each contract is 5,000 ounces. So that's 269.76 million ounces of silver still committed to March delivery. Yesterday, March open interest dropped by 3,111 contracts. Sounds like progress, right? Contracts rolling out of March. But May open interest only went up by 24.18. Have you ever wondered what's really going on with the price of silver? We see the spot price on our screens, but does it reflect the true state of the market? Today, we're diving deep into the silver market, and what we uncover might just shock you. We're looking at some serious signs that the paper silver market, particularly the COMEX, is in a state of distress, maybe even a death spiral. Let's start with a phenomenon I call contract vanishing. It's something truly bizarre. In recent months, we've seen a massive number of futures contracts for silver simply disappear right before they are due for delivery. Think about it. Traders hold these contracts, supposedly ready to take physical delivery of silver, but then poof, the contracts vanish. For example, in a recent delivery month, we saw over 90% of the open interest just evaporate in the final days. This isn't normal market behavior. It suggests that the holders of these contracts, who are typically large banks, can't or won't deliver the physical metal. They'd rather close out the positions, even at a loss, than face the reality of not having the silver. It's a shell game, and it's a huge red flag that the paper promises far exceed the physical reality. Next, let's talk about backwardation. For those who aren't familiar, backwardation is when the spot price of a commodity is higher than its futures price. Normally, it should be the other way around. It costs money to store and insure silver, so future prices should be higher. This is called contango. But we are seeing persistent backwardation in the silver market, sometimes for extended periods. What does this mean? It means people want silver right now, today, more than they want it in the future. They are willing to pay a premium to get their hands on the physical metal immediately. This is a classic sign of a supply squeeze. The market is screaming for physical silver, and it's so tight that the normal rules of pricing are being turned upside down. When you combine this with the vanishing contracts, a clear picture emerges. The demand for immediate physical silver is intense, and the paper market is struggling to cope. Now let's look at the vaults, specifically the COMEX registered silver inventory. Registered silver is the silver that is fully available for delivery against futures contracts. It's the real stuff, ready to go. And what has been happening to it? It's been plummeting. We've seen a dramatic and steady decline in the amount of registered silver held in COMEX warehouses. At the same time, the amount of eligible silver, which is metal stored in the vaults but not available for delivery, has stayed relatively stable or even increased. Why aren't owners of that eligible silver converting it to registered to take advantage of high prices? Perhaps they don't want to sell at these manipulated paper prices. The shrinking pool of registered silver means there's less and less metal to back the mountain of paper contracts. The ratio of paper claims to physical silver is getting more and more absurd. We're talking hundreds of paper ounces claimed for every one physical ounce available for delivery. It's an inverted pyramid teetering on a tiny point of real metal. How long can that possibly last? This brings us to the COMEX itself and its interventions. When a system is under this much strain, the people running it start to take desperate measures. We've seen some very questionable actions. For instance, there have been massive, sudden drops in the price of silver, often happening in the dead of night with very low trading volume. These paper raids seem designed to shake out long positions and suppress the price. They happen with no corresponding news or fundamental reason. It feels like a direct intervention to prevent the price from breaking out, which would expose the lack of physical metal. Furthermore, the COMEX has changed rules in the past when it's been under pressure. If they are willing to change the rules of the game mid-play, can you really trust the game at all? These actions don't inspire confidence. They scream desperation. They are trying to patch a dam that's about to burst. So, if the paper price is being suppressed, where can we see the real price of silver? Let's look at the mining companies. These are the companies that pull the silver out of the ground. You would think they sell their silver at the spot price, right? Well, not exactly. If you dig into the financial reports of major silver mining companies, you'll find something called the realized price. This is the actual price they get for their silver. And guess what? For many of them, their realized price is significantly higher than the spot price you see on your screen. How is this possible? It's because they are selling a large portion of their production directly to buyers like mints, refiners, and industrial users who are willing to pay a premium over the paper price to secure a physical supply. This is the ultimate proof that the COMEX price is broken. The producers, the very source of the silver, are getting a better price elsewhere because the real physical market is much tighter than the paper market lets on. When you put all these pieces together, the vanishing contracts, the persistent backwardation, the draining vaults, the desperate interventions, and the miners getting higher prices than the market shows, the conclusion is inescapable. The paper-silver market, centered on the COMEX, is fundamentally broken. It no longer functions as a true price discovery mechanism. Instead, it's a price suppression scheme that is rapidly losing its grip on reality. We are witnessing what could be the death spiral of the COMEX as a legitimate pricing venue for silver. Every ounce of physical silver that leaves the vaults and doesn't come back tightens the noose. Every contract that vanishes exposes the lie. Every moment of backwardation signals the urgency of physical demand. The pressure is building, and the disconnect between the paper price and the physical reality is growing wider every day. So what does this mean for you? It means that the price you see on TV is a fantasy. The true value of physical silver in your hand is likely much higher and is being actively hidden from you. The big players are in a panic, trying to hold the system together with paper clips and tape. But fundamentals always win in the end. A market that has hundreds of paper claims for every ounce of real metal is a house of cards in a hurricane. It's not a question of if it will collapse, but when. And when it does, those holding physical silver will be the ones who are protected. The paper promises will be shown for what they are, worthless. We are living in historic times for the silver market. The game is almost over. Pay attention, because what happens next will redefine the meaning of real money and real value. Thanks for watching and digging into this with me. If you found this analysis valuable, make sure to like this video and subscribe to the channel for more deep dives. Stay informed and stay prepared. See you next time. And every earnings report that shows a premium above COMEX is another nail in the coffin of paper price discovery. Now, let me show you what the U.S. government said today that ties this all together. Undersecretary of State Jacob Hellberg gave new quotes about the critical minerals price floor system. Quick context if you haven't been following this. On February 4th, Vice President Vance stood in front of representatives from 55 countries and announced that the U.S. is building a reference price system for critical minerals, including silver, a floor price maintained by tariffs. The EU, Japan, and Mexico agreed. Trump launched Project Vault, a $12 billion strategic minerals reserve. I covered this in full detail in a recent video, link in the description. Today, Hellberg went further. He said they have developed a very, very sophisticated price floor system. And then he said this: "We are very excited about it because pricing is the key to unlocking private investment. Pricing is the key to unlocking private investment." Let that sentence sink in. The U.S. government is saying out loud that the current price of critical minerals is too low, that the price needs to be higher, and that they've built a system to make it higher, so that mining companies will invest in new production and processing. A government official used the words "very excited" about a price floor for silver. When was the last time a government official was excited about making a commodity more expensive? That tells you everything about how serious this is, and I want you to think about the irony of what's happening. The bullion banks, the big commercial shorts on COMEX, they've been fighting to push silver prices down for months. They crashed at 46% on January 30th. They're trying to scare longs out of the market. And while they're doing that, the United States government is building a price floor to guarantee that silver prices stay high. The shorts are fighting against their own government. The same government that controls tariff policy. The same government that just launched a $12 billion strategic reserve. The shorts are on the wrong side of history and on the wrong side of their own country's stated policy. That's not a position I would want to be in. And look at the timing. This comes out while COMEX is draining at 20 million ounces per month. While two miners are reporting 26 to 30% premiums, while the March roll is failing at half speed, the government is building a floor under silver at the exact moment the physical market is proving it desperately needs one. The price floor is not a safety net. It's a launch pad. Now, I told you I'd give you 5 specific signals to watch over the next 5 trading days before first notice day. Here they are. First, the daily roll rate. If March open interest is not dropping by at least 6,000 contracts per day, the roll is behind schedule. Watch this number every day. I'll be covering it. Second, registered silver. If it drops below 85 million ounces before first notice day, a normal March delivery becomes nearly impossible. We're at 88 right now, 5 million ounces away from that line. Third, the March may spread. If backwardation deepens, meaning March starts trading at a bigger premium to May, It means urgency for immediate delivery is increasing. That's the market screaming for metal. Now, fourth, margin hikes. If CME raises initial margin requirements on silver futures, that's the early warning that they see the problem, and they're trying to reduce open interest by making it more expensive to hold positions. And fifth, the eligible category. If eligible silver starts dropping alongside registered, it means even the silver that is not currently available for delivery is being pulled out of the system entirely. That would be the single most alarming signal for COMEX inventory. I'll be tracking all 5 of these daily. Subscribe so you don't miss the updates. Let me connect everything now because separately, these are interesting stories. Together, they tell you something that I think the financial media is completely missing. The vault is draining at 20 million ounces per month. It's gone from 200 million to 88 million. The roll is running at half speed. Backwardation confirms urgency. The delivery rate in February was 98%. January delivered 7 times the prior year. 2 miners are both getting $69 for $55 silver. Industrial buyers are bypassing the exchange. Samsung is locking up entire mines. The US government is building a price floor because the current price is too low. In total, 2025 deliveries doubled over 2024. Every single one of these data points says the same thing. There's not enough silver, and the system that pretends there's enough silver is breaking down in real time. And I want to bring it home to you personally because this is not just about COMEX or futures traders or industrial buyers. If you hold physical silver, this data tells you your metal is worth more than the price on your screen. The real market is paying far above the paper price. Shanghai is paying even more. The government is building a floor to make sure it stays high, and the vaults that are supposed to have enough silver for everyone are running dry. If you're thinking about buying physical silver, this data tells you the window may be closing. And when APMEX couldn't ship for a month after the January crash, that was a preview. If COMEX intervention triggers another price spike or another shortage, dealer delays will be even longer next time because there's less silver in the system now than there was in January. And if you're watching this and thinking, surely someone will fix this, ask yourself who. The miners can't increase production fast enough. New mines take 7 to 10 years to build. The exchange can't manufacture silver. They can only change the rules around who gets what's left. And the government just told you they want prices higher. Nobody's coming to push prices down. Everyone with power wants them up. I want to be honest with you. I've been analyzing this daily for weeks, and every day I look for the counter argument. I want someone to show me the data that says this is fine, that the vault will refill, that the roll will catch up, that the premiums will disappear. Every day I look, and every day the data gets worse. Not sideways, not ambiguous, worse. The vault goes lower, the premiums go wider, the roll goes slower. At some point, you have to trust what the numbers are telling you. And here's where I stand personally. I think COMEX is heading towards some form of intervention before March is over. I think the 69 realized price from these miners is closer to the real value of silver than anything on a futures screen. And I think the government price floor announcement is the beginning of a permanent shift in how silver is priced globally. That's my read on the data. You can disagree, but that's what the numbers tell me. 5 trading days, 88 million ounces, a roll at half speed, a 98% delivery rate, 2 miners at $69, a government building a floor, and a chart that points to 0 by March 6th. You can raise margins, you can crash the price, you can change the rules of the exchange, you can offer cash premiums to convince people not to take delivery, but you cannot create silver that doesn't exist. You cannot refill a vault that's been draining for 5.5 months. You cannot unreport the earnings that 2 mining companies just filed showing they got paid 30% more than the exchange price. And you cannot convince industrial buyers to trust an exchange that is running out of the one thing it's supposed to deliver. The system is telling you something. Every data point, every earnings report, every vault number, every delivery rate, every government statement, they're all saying the same thing. And at some point, the price on your screen will have to catch up with what the physical market already knows. This is my opinion, not financial advice. Do your own research, make your own decisions. But I've never seen this many data points all pointing in the same direction at the same time. The paper silver market is running out of time and the physical market has already moved on without it. Drop a comment and tell me whether you think COMEX makes it through March without intervention. Yes or no, and tell me why. I'll pin the best responses from both sides. Share this video with one person who still thinks the silver price on their screen is real. Show them the vault chart, show them the miner earnings, and ask them to explain how 2 different mining companies both got $69 for $55 silver. If you're not subscribed, hit that button now. 5 days until first notice day. I'm covering every single data point between now and February 27th. The vault numbers, the roll rate, the spreads, all of it, every day. Subscribe so you don't miss what happens next. This is the hidden economy. Stay sharp. Stay stacking.